Despite Bitcoin closing March in positive territory for the first time after 5 consecutive red months, something not seen since 2018, the price action has been extremely tense. In just 4 days, from March 30 to April 2, Bitcoin moved no less than $2,000 up or down every single time U.S. President Donald Trump spoke on Truth Social. On March 30th, Trump posted that the U.S. was holding serious talks with Iran, causing markets to jump and short liquidations to exceed $340 million in hours. Then, the same day, he completely flipped and threatened to destroy Iranian energy infrastructure, sending Bitcoin down $2,000 in minutes. On March 31st, a softer tone brought talk of a possible end to the crisis, and Bitcoin rebounded $2,000. On April 1st, renewed talk of serious negotiations pushed Bitcoin close to $68,000, with Ethereum up 4% and Solana up 3%. Then, on April 2nd, Trump's evening speech warning of a severe strike on Iran within 2 to 3 weeks sent Bitcoin down 3% to around $66,000. The Fear and Greed Index remains stuck in extreme fear, and the deeper problem is uncertainty. The geopolitical crisis has no fixed timeline and is driven entirely by words and statements. Iran's foreign minister denied any ceasefire talks, while simultaneously confirming a desire to end the war. A contradiction that perfectly captures the full geopolitical fog. As long as this fog persists, the market will remain more hostage to Trump's posts than to any on-chain data. Behind the political noise, however, there is a more complex structural story. 4 types of players are acting simultaneously with completely different bets. Whales are selling, as the whale-to-exchange ratio is rising, and large deposit activity signals distribution. Public companies bought 62,000 BTC in Q1 2026, largely through Michael Saylor's strategy, which never stops buying even during price drops. Spot ETFs led by BlackRock are attracting inflows, but grayscale outflows are largely offsetting them. Retail investors appear to have mostly left the game, recording net outflows. This split explains why Bitcoin isn't moving in a clear direction. Capital forces are distributed across opposing camps. On the ETF front, spot Bitcoin ETFs recorded $1.3 billion in inflows in March, their first positive month in 2026 after $6.3 billion in accumulated losses from November through February. However, a closer look reveals that late March inflows were partly driven by end-of-quarter portfolio rebalancing rather than genuine new conviction, and $174 million was withdrawn on April 1st alone. The full Q1 ended with a net loss of $496 million, the second worst quarterly performance after Q4 2025. Ethereum ETFs tell an even darker story, with 5 consecutive months of outflows including $200 million in just the last week, reflecting a deeper decline in institutional demand. Solana ETFs, by contrast, have maintained positive flows for 6 consecutive months since their October 2025 launch, with cumulative inflows approaching $1 billion. Bitcoin closing March up roughly 2% near $68,000 ended 5 consecutive months of losses. And the last time this happened was 2018, which was followed by a rally exceeding 300% over 5 months. This comparison is optimistic, but deserves scrutiny, as it is based on a single historical instance, a fragile foundation for strong expectations. A sustained rally would likely require clear closes above $70,000, $72,000, though notably around $650,000 BTC was purchased in that range, meaning most of those investors are currently at a loss and may use any return to their entry price as an exit opportunity. On the seasonality side, in 9 out of 13 years, April moved in the opposite direction of March, and in 3 of the last 4 years, April declined after a green March close. This doesn't guarantee a drop, but it means a monthly green candle alone isn't enough for sustained performance. The current bias points towards sideways, range-bound trading continuing through April, and possibly all of Q2 unless uncertainty clears. Digging deeper on-chain, the average single deposit to exchanges rose to 2.62 BTC, a level typically only seen during intense market stress, last reached during the February crash, suggesting whales are preparing to sell. Additionally, dormant wallets over 10 years old began moving, with over 600 BTC worth roughly $41 million stirring after a decade of inactivity. Whether from financial pressure or a belief this is the cycle top, no one can say for certain. On the corporate treasury side, Metaplanet bought around 5,075 BTC in Q1 2026 for roughly $405 million and now holds 40,207 BTC worth about $4.18 billion, though their average purchase price of $104,000 means they need to accumulate more at lower prices to bring that average down. Their dual model, a long-term treasury that never sells alongside a separate options-based investment portfolio, generated $18.5 million in Q1 revenue. Meanwhile, smaller companies are sending mixed signals, with Nakamoto selling 284 BTC, worth roughly $20 million last month. Finally, Warren Buffett recently bought $17 billion in U.S. Treasury bills, and Berkshire Hathaway now hold around $373 billion in cash and equivalents, double its end of 2023 level, signaling his expectation of a stock market correction after years of what he views as overvaluation. This matters for Bitcoin because the 20-week rolling correlation between Bitcoin and U.S. stocks currently sits around 0.5, a moderate positive correlation, meaning what hits Wall Street will likely hit Bitcoin too, as both are classified as risk assets.